A very good morning to everyone and welcome to the BPAM Bond Market Workshop, the first in our exciting webinar series. My name is Kuzo here from the BPAM Partnerships, Retail Products and Media team. I am honored to be your MC for today's event. On behalf of BPAM, we're thrilled and grateful to have you with us and for what promises to be a truly insightful session. So before we begin, I'd like to extend a warm welcome to our esteemed speakers, industry experts, professors, students, and all participants who have joined us today. We hope you find the session valuable and leave with new knowledge and insights. So to start things off, I'd like to share a bit about us. BPAM is a leading provider of evaluated prices and data for the Malaysian fixed income market. Since 2005, we've built a strong reputation for independence, accuracy, and service. With over 100 global clients, we are the go-to choice for fund managers, dealers, brokers, and risk managers. So our commitment to maintaining objectivity is upheld through strict adherence to internal and regulatory standards. We are dedicated to advancing the Malaysian bonds and sukuk markets, collaborating closely with market participants and stakeholders. On that note, I'm pleased to announce that we will be joined by someone who has been a key figure in BPAM's success over the years. We are honored to have with us today BPAM CEO and Executive Director, Encik Mio Amri Mio Ayo. Under his leadership, BPAM has evolved into the primary source of valuation and data reference for the Malaysian bond and sukuk market. We are also privileged to have with us today Mr. Kevin Tay, BPAM's Market and Economic as today's trainer. Kevin has been instrumental in the valuation of Malaysian bonds and sukuk portfolios and has contributed extensively to the company's in-house research articles and economic commentaries. So with the help of our trainer today, Kevin, our focus for today is equipping you with the knowledge to navigate the financial markets. By the end of the session, you'll be able to differentiate between various financial markets, interpret key economic data, and understand the monetary policies of major central banks. We'll also explore how geopolitical developments influence these markets, allowing you to see the bigger picture of how these factors come together. So to ensure you get the most out of today's workshop, let me give you a quick overview of our agenda. We'll begin with an introduction on financial markets, where we'll explore the different types of markets, including the stock market, derivatives, commodities, forex, cryptocurrency, and the bond market. Within the bond market segment, we'll look into the basics of bonds, the infrastructure, and the key participants, as well as understanding yield curves and bond valuation. Next, we'll move on to the factors that move the markets. So in this section, we'll discuss the key market indicators such as benchmark interest rates and crucial macroeconomic factors. To see these concepts in action, an interesting and relevant case study on the US-China trade war will also be discussed. We'll then have a short 5-minute break before swiftly moving on to topic 3. Central banks, monetary policy and tools. Here you'll learn about the tools central banks use, the monetary policies of major central banks, and an explanation of the central bank's balance sheet. So lastly, we'll delve into the geopolitical developments and the impact on the financial markets. So this segment will cover how geopolitical conflicts, global flashpoints, and emerging world orders influence markets. We'll also touch on the safe haven assets and discuss unpredictable black swan events. So after topic 4, we will be doing a short 3-question MCQ quiz, whereby you can test your knowledge on today's materials. So a few housekeeping notes for you all before I pass on the floor. This will be an interactive session, and after each topic is presented, we'll open the floor for a Q&A. You can submit your questions during the session by scanning the QR code displayed on the bottom right-hand corner of the screen. But not to worry, this will appear on each slide throughout the workshop. We'll also be doing our best to address each question in turn. However, if time runs short, we'll follow up with you directly by email after the webinar concludes. Please ensure that your questions are relevant to the topic being discussed and appropriate for this webinar. So additionally, as you can see on the screen, to receive your workshop certificate, please scan the QR code displayed on the screen to register your attendance. In case you've missed it, don't fret, this too will be on the bottom right corner of the screen of each slide. So I will now like to invite BPAM CEO and Executive Director Encik Mio to give his welcome speech. Encik Mio, you now have the floor.
Thank you so much, Zohair, for the introduction. Assalamualaikum, and a very good day to all of you, wherever you may be. Welcome to BPAM's Bond Market Workshop 2024. My name is Mio Amri bin Mio Ayub. Now, I'll start the introduction with this very old adage: out of sight, out of mind. Now, why I say this? Now, this is actually a very apt description of the Malaysian bond and sukuk market from the point of view of the general public. For a number of you who have registered for this event, the Malaysian bond and sukuk market is rather opaque and not as transparent as the local equity market. The current bond market infrastructure currently is actually set up as a wholesale market instead of a retail market. So this has the effect of limiting the number of market participants. This in turn cause a lack of coverage, and hence information affects the level of interest on the subject by all of you. Now, if you look in the slides that I have put up, there's just two slides in my introduction. If you can see the slides there, the size of the market is actually very significant. Now, the table is a bit too small. I'm not sure whether you can see it from where you are, but just look at the graph itself. The blue line describes the market capitalization or the amount outstanding for the Malaysian bond and sukuk market, while the red one is all the securities listed on the Bursa Malaysia. So as you can see, for the last 12 months or so, the bond market is exceedingly bigger than the equity market. Yet you don't see the level of coverage that what you see for the equity market. So it is significant. And if you can, I have the second slide. And if you look at the secondary trading of the market itself, the trading volume itself, again, the blue line reflects the bond market, while the red line reflects the all the securities on Bursa Malaysia. Again, you see that the amount on transaction at the secondary bond market is exceedingly larger than what you see at the equity. In fact, in the last, we have not ended August yet, so there's just a few more days before August ends. But the trading at the bond market has already exceeded more than 100 billion for the month of August. So the size is very, very, very significant. And this is actually very, very important because it affects the economy. There is impact to the economy. Now, the market will eventually open to all. You and me will be able to directly buy into the Malaysian bond sukuk market. It's not the question on if, but it's the question of when. So again, another adage that I would like to bring up now is, what comes first, the chicken or the egg? Should financial literacy of the market be known now or after the market is open to all? So we as a company, we are a strong believer in knowledge. As such, we will be conducting more of these workshops that you see right now in the future to support the understanding of this. So ladies and gentlemen, I hope today's workshop will be able to give you a better grasp of the market. It may not be able to answer all your questions, but at least answer some of them. So without further ado, let me pass it back to the MC and to start the event. Back to you, Zoe.
Thank you, Encik Mio, for your time and encouraging words. So now it's time to commence the BPAM Bond Market Workshop. So I would now like to invite our economics and market expert, Mr. Kevin Tay. Kevin, take it away.
Top of the morning, guys. I'm Kevin Tay. This workshop is intended for those who are new or have no experience in financial market. Without further ado, let's start. Let's begin with the learning outcomes. After today's workshop, you all will be able to differentiate types of financial market, interpret major economic data, distinguish and understand various monetary policy tools, identify geopolitical developments around the world, and explain overall effects of economic data, monetary policy, and geopolitical developments on the financial market. Okay, let's get straight to topic 1, Introduction to Financial Markets. Let's look at the types of financial markets. Firstly, we have the capital market, which is made up of stock market and bond market. As the name suggests, it's for the issuer to raise capital through issuing stocks or bonds. Then we have derivatives market like futures and options. We also have commodities and forex market. Last but not least, we have the cryptocurrency market. Some markets are actually overlapping with each other. For instance, the commodities and futures market or forex and futures market. Okay, before we look at the individual market, let's look at the typical trade flow and the parties involved. First, we have the buyer who wants to buy some stocks or bond. He or she has to go through a broker whose main job is to facilitate the trade by looking for a seller, typically through the exchanges if they are exchange traded, or over the counter if they are not exchange traded. Over the counter market is typically for stocks that don't meet the exchange requirement, or they don't want to go through the IPO process. For example, the pink sheet stocks in the US. However, for bond market, most of the bond trading is done over the counter through the interbank bond dealers. Next, let's look at characteristics and main functions of the stock market. It's mainly traded on stock exchanges. It facilitates listing and trading of shares. Each stocks exchange has a stock market benchmark index to track performance. Then we have stock brokers like Charles Schwab's, Moomoo, or Maybank Securities, for instance, who provide a platform for online trading. Or if you are old-fashioned type, you can call your brokers to place orders. Next, order placed with brokers can be market order, limit order, day or good till cancel order. If you place a market order, your order will be executed at the current market price. For example, if the NVIDIA stock is currently trading at $100, if you place a market order to buy at 100, you will get the trade done even if the NVIDIA stock price moves to $101. The result will be different if you place a limit order of 100, whereby only at 100 or less, your order will be executed. Day order and good till cancel order are pretty straightforward. Either your order will be in force for the current trading day, or it will be in force until you cancel it. Sometimes it could last a few months. While a clearinghouse acts as a mediator between two entities or parties that are engaged in a financial transaction to make sure the transaction runs according to plan. And finally, stock market is regulated by Securities Commission. Moving on, we have the derivatives market. It trades on derivatives exchange like Bursa derivatives. In futures market, participants buy and sell futures contract for delivery on a specific future date. Some of the financial instruments that are traded on futures market are stock indices, commodities, interest rates, and so on. Meanwhile, in options market, the buyer has the option to exercise the contract at the strike price, but is not under any obligation to do so. A typical US stock options contract controls 100 units of underlying stocks. Generally, we have two types of options, which is a call and a put option. To put it simply, if you buy a call option, you are bullish on the stock, and vice versa. If you buy a put option, you are bearish on the stock. Of course, they are more complicated than that, but we are not going to talk about it today. For order types, initially, if you don't have any open position, the moment you enter a position, it's always buy to open or sell to open, depending on what is your view on the market. Then once you have opened a position, you can sell to close or buy to close to exit the position. Futures and options are leverage products, and so the broker will ask you to put up a margin before you can trade. Derivatives market is also regulated by Securities Commission. Next, we have the commodities market, which is also a futures market normally. Commodities like crude palm oil has standardized future contract and is traded on Bursa derivatives. For instance, the crude palm oil futures contract, or FCPO, has a specific terms and conditions. You all can download the spec sheet of this FCPO from Bursa derivatives website if you are all interested. Besides crude palm oil, commodities like crude oil, wheat, corn, copper, gold, and many more can also be traded. On the maturity date, the futures contract can be settled by means of physical delivery or cash settlement. Typically, crude palm oil has to be settled physically, which means investors who don't have the mean or intention to see 25 metric tons of crude palm oil appearing at their doorstep should close the futures contract 1 or 2 months prior, just to be safe, because the open interest of the futures contract may shrink when nearing the maturity date. Open interest is just the number of open or outstanding derivatives contracts that have not yet expired, closed, exercised, or physically delivered. Compared to palm oil futures contract, KLCI futures contract is settled in cash. As for margin requirement, depending on the market condition, brokers may require investors to put up more cash in their accounts if the market is getting more volatile. Next, we have the Forex market, which is mainly an OTC market in which the big banks provide the liquidity. That means you can buy or sell a currency with your brokers, but ultimately the brokers will pass your orders to the banks. Forex movement is in pip or percentage in point. Other than the Japanese yen currency pairs, a pip is at the 4th decimal as shown in the red color digit. Japanese yen pairs are at the 2nd decimal place as shown in the green color digit. Depending on your contract size, 1 pip movement is about $10 for a standard lot, which is made up of 100,000 units of underlying currency. Some Forex brokers allow you to trade in mini lot, which is just 1/10 of the standard lot, and hence a single pip movement is just $1. Currencies are quoted in pairs because the value of one currency is always determined in relation to another currency. For example, if you want to know how much €1 is worth in US dollars, you can look at the Euro-USD pair. The convention for quoting currency pairs typically place the base currency on the left and the quote currency on the right. The base currency is the one you are buying or selling, and its value is expressed in terms of the quote currency. For instance, Euro-USD is a standard quote that indicates how many US dollars are needed to purchase €1. Next, cryptocurrencies operate on decentralized network based on blockchain technology, which is a distributed ledger enforced by a network of computers. For cryptocurrency market, it's not for the faint-hearted. It's extremely volatile and maximum drawdown can be over 90% or even wipe out your entire investment. Amongst all, Bitcoin is the poster boy of crypto, while the rest are altcoins and meme coins. For examples, altcoins are like Ethereum, Solana, Cardano, Ripple, and so on, while the examples of meme coins are Dogecoin, Shiba Inu, etc. For cryptocurrency brokers, we have Luno in Malaysia, which is also one of the licensed crypto brokers regulated by Securities Commission, Malaysia. Some of the lingo or slang associated with cryptos are HODL, which stands for hold on for dear life, which originated from the word hold. It has been claimed that someone has nervously and mistakenly typed that into internet when the market crashed. FUD stands for fear, uncertainty, and doubt. FOMO stands for fear of missing out. And RECT, R-E-K-T, stands for RECT. Diamond hands is a slang term for an investor who refrains from selling despite downturns or losses. Crypto market is largely unregulated, but it's slowly getting recognized. For instance, Bitcoin and Ethereum ETFs were approved for trading in the US just this year. Last but not least, we have the bond market. Predominantly an over-the-counter market, but some are exchange traded as well. I believe you all always heard of this word Sukuk when reading financial news. Sukuk is just a Sharia-compliant bond-like or debt-like instrument. Movement for bond is in basis point. 1 basis point is 0.01%. And by the way, the bond market is mostly dominated by institutional investors since it's an over-the-counter market. In terms of claim, bondholders are paid first over stockholders in the event of a company's bankruptcy. Finally, it's also regulated. In Malaysia, it's under the purview of Securities Commission Malaysia and the Bank Negara. For the types of bond issuer, we have sovereign bonds issued by the government. In Malaysia, we also have the quasi-government bonds or government guaranteed bonds issued by the GLCs like Dana Infra and Prasarana. Of course, there's also traditional corporate bond or Sukuk. What is unique for bond as a mean for raising capital is that it can be linked to any infrastructure projects like highways or power plants. Repayment of the bond coupon or interest can then be tied to the cash flow projection of the underlying projects. Next, we have the mortgage-backed securities or MBS, like the Chagamas MBS. We also have the asset-backed securities or ABS. Examples of ABS in Malaysia are Al-Zahab and Zamarat, backed by a portfolio of personal financing facilities extended to civil servants, which originated by RCE marketing, repaid via salary deductions. Lastly, special purpose vehicles or SPVs have their own debt obligations independent of the parent company. SPV can issue bonds to raise additional capital at better interest rate than the parent company could. Typically, their debt obligations are guaranteed by the parent company anyway. Next, let's look at who are the bond market participants in Malaysia. Firstly, we have the issuers and investors for obvious reason. Then we have the regulators in Securities Commission and Bank Negara to regulate and oversee bond market to ensure transparency, fairness, and investor protection. We also have intermediaries like the brokers, Fund Supermart, for instance, and even BIX Malaysia. Fund Supermart has its own platform called FSM1 to trade bond and Sukuk, while BIX Malaysia provides free public access to information on bond and Sukuk issued in Malaysia. Next, we have the trustees who represent and protect the interests of the bondholders in accordance with the trust deed, as well as to act as a focal point for interaction between bondholders and issuers. Then we also have rating agencies. In Malaysia, there are RAM Ratings and Mark. On the global setting, we have S&P, Moody's, and Fitch Rating. The role of rating agency is to assign a credit rating from AAA to D for bond issuance. AAA is the best credit rating issuers can get, while the D, the bond is already in default. Last but not least, bond pricing agency like BPAM provides bond prices to clients. Those clients include unit trust and asset management companies, banks, and insurance companies. Moving on, let's look at the mode of issuance for bonds in the primary market in Malaysia. First on the list, the issuance of government bond is done through auction via competitive bids from principal dealers. Who are the major banks in Malaysia? Government bond issuance can be a new issue, which means they issue bond with a new maturity date, and it also can be a reopening, which means they increase the outstanding amount of existing issuance instead of issuing new bond with a new maturity date. Book building is a process of generating a book of investors' demand for corporate bond offering for the purpose of efficient price discovery. Usually, the issuer appoints a major bank to act as a book runner. During the fixed period of time for which the book is open, the book runner collects bids from investors at various prices. The final issue price is not determined until the end of process when the book has closed. Subsequently, the book runner accesses the bids based on certain criteria and sets a final issue price. The third one, bought deal, means the lead arranger or the bank buys the entire issuance from the issuer and then resell it to the investors. Last one is the private placement. It happens when the issuer makes an offering of bonds directly to an individual or a small group of investors. That's the end of topic 1.
I think for those just beginning their journey into finance, I think gaining a comprehensive overview of the various types of markets is crucial. So it sort of lays the groundwork for everything that has to follow. So thank you, Kevin, for that. Before we move on to the factors that influence these markets, it's now time for our topical Q&A session. If you have any questions and haven't done so already, so kindly scan the QR code on the screen now and make sure to choose the correct topic, topic 1. Over to you, Kevin.
Okay, thank you, Zohe. We have a couple of questions here. The first one, what kinds of futures are there in the Malaysia market? What kind of future? I believe what kind of futures product, okay, are there in Malaysia market? Okay. Futures market in Malaysia, the main one will be the crude palm oil, as mentioned just now. The second major one is the KLCI Composite Futures Index. And then I also believe we have the gold futures contract, which you can trade gold future, but is cash settled. So the difference will be settled in cash instead of physical delivery. So those are the 3 major ones. Of course, we also have the crude palm oil, but settled in US dollar. For the details, you can go to Bursa Derivatives. I believe they have all the specs listed there. So I hope that answers the question. So for question 2, what does peer-to-peer crowdfunding fall under financial markets in Malaysia? I think peer-to-peer crowdfunding will be another market altogether, and it's not one. It's definitely one of the major capital raising platform, but it's not under the one I have mentioned just now. It's another market altogether. Yep. So that's all for the questions. You guys can still send in questions if you want. We still wait a couple of minutes.
Thank you for that, Kevin. So I think it's now time to move on to the next topic. Topic 2, factors that move the markets. So back to you, Kevin.
Thank you, Zohe. In topic 2, let's look into factors that move the market. So what moves the market? We have greed, where investors chase the price higher. They want to get in at whatever price now. On the opposite side of the scale, we have fear, where investors bid the price lower. They want to get out at whatever price now. Additionally, herd mentality will also drive the market prices, as the minority is fearful of being left behind and will follow the majority to buy or sell. Uncertainty also plays a part in market movement, especially unexpected earnings or economic data, surprise election result, or a sudden war that breaks out in some hotspot somewhere. Finally, is the demand and supply imbalance. More people buying than selling will cause the price to go higher, while more people selling than buying will cause the price to go lower. Moving on, we look at variables that affect the financial markets. Generally, economic data will affect forex, equity, and bond, but it has less bearings on commodities, like while monetary policy affect all of them. Another factor to take note is the political and geopolitical developments, like war, which cause most of the asset classes to fluctuate. But the effect could be just a knee-jerk reactions most of the time. For fiscal policy, it will affect the forex and bond market the most. Case in point, in September 2022, if you all still can remember, the disastrous mini budget unveiled by the then British Prime Minister Liz Truss includes a £45 billion of unfunded tax cut that sent the pound sterling tumbling. United Kingdom's sovereign bond yields also spiked significantly owing to fear of large government borrowings. Finally, one variable that is unique to the commodity market is the demand and supply imbalance. For instance, a glut will cause the commodity price to fall. Okay, let's move on to the next section, which is the economic data. And first on the list is the GDP. When you read the GDP news, right, you need to know whether the GDP data is the advanced estimate, preliminary estimate, or final estimate. Market impact is high for advanced estimate as it provides the first glimpse of economic condition during the quarter, but low for second and final estimate unless it contains huge revision to the previous numbers. GDP data will be released quarterly and will be on year-on-year basis, meaning comparing the level this year over the same period last year. For example, the GDP level in the second quarter this year to the GDP level in the second quarter last year. Sometimes we also see some GDP reporting in quarter-on-quarter growth basis, which is just the GDP level this quarter compared against the GDP level in the last quarter. Generally, the GDP calculation is based on expenditure approach, which consists of consumption plus government spending plus investment plus net exports. The consumption, government spending, and business investment are considered as domestic demand, while the net export is considered as external demand. All the domestic and external demand contribute to the GDP of a country. Other measures are production approach and income approach, but they are not widely adopted and used, so we are not going to discuss it here. If you all come across any news report of a country's GDP, it probably looks like this. Highlighted in red in the first paragraph, a GDP growth of 4.2% from a year earlier in the first quarter means the current GDP level is 4.2% higher than what was observed last year in the first quarter. Sometimes you will see terminology like year-on-year or on annual basis. It means the same thing. Second paragraph, quarter-on-quarter growth of 1.4% means the current level observed in the first quarter this year is 1.4% higher than what was observed in the previous quarter. More often than not, the GDP news would have mentioned whether the number is higher or lower than the median estimate or the market consensus. A huge deviation from the market consensus will move the market. Okay, let's move on to inflation. We have multiple tools to measure inflation, like the Consumer Price Index or CPI, Producer Price Index or PPI, and Personal Consumption Expenditures or PCE. Keep in mind, the price stability is one of the major objectives of any central banks, and normally their target is around 2%. Just to take note, if we are talking about a negative growth in the inflation, we are actually talking about a deflation. In general, there are two types of inflation. A demand pull inflation is the increase in aggregate demand caused by an expanding economy, increased government spending, and external demand. While a cost push inflation is the decrease in the aggregate supply of goods and services stemming from an increase in the cost of production from labor, capital, land to entrepreneurship. Central banks will normally react to demand pull inflation by increasing interest rate to cool down the economy, but less likely to react to cost push inflation because more often than not, the supply shock is only temporary. Next, we come to the Consumer Price Index or CPI, which measures changes in the prices paid by consumers for a basket of goods and services. CPI is one of the high-frequency economic data that is released monthly. The reporting format is on year-on-year or month-on-month basis. The market impact is usually very high, especially these days when the inflation is rampant. Sometimes we also come across terms like core CPI, which is just the normal CPI, but exclude the volatile food and energy prices. This is how a typical CPI news looks like. It says the US CPI falls 0.1% month-on-month, but the increase 3% year-on-year in June, while the core CPI gains 0.1% month-on-month, but rises 3.3% year-on-year during the same period. Due to this benign inflationary pressure, market players expect the Fed to begin cutting interest rate in September. Okay, why did we don't feel the price soften at all? This CPI index chart explains the reason why we don't feel like the prices is dropping, even though the government is telling us the CPI is only at 2.5%. Using US as an example, the consumer prices have increased tremendously between year 2020 and year 2023. And only in 2024 that the inflation has plateaued. When the government tells us, oh, the inflation is only 2.5% year-on-year this month, they are comparing this month level against last year level in the same month, which indeed only shows a 2.5% increase. But the government is not comparing this year level against the level in 2020, which could have increased more than 20% already. Bear in mind, consumer prices are sticky. They seldom come down. That's why the shape of the curve is upward sloping. Next, the Producer Price Index is a monthly estimate of weighted average prices producers like the suppliers, wholesalers receive for the products and services they create. Unlike the Consumer Price Index, which tracks the prices from the perspective of the consumer, the PPI reflects the prices producers get for goods and services at the wholesale level before they reach consumers. The PPI is used to assess inflationary trends in the economy, as increases in the Producer Price Index can eventually lead to higher consumer prices. Anyway, CPI and PPI are closely tied. If a business has to pay more for its suppliers, right, it's usually going to charge consumers more for their products and services in order to maintain its margins. In this way, PPI is a leading indicator because an increase in PPI often happens before an increase in the CPI. Market impact is high for export-oriented economy like China. Okay, personal consumption expenditures or PCE is a key economic indicator that measures the value of goods and services consumed by households. It includes spending on essentials like food and housing, as well as non-essentials like entertainment and durable goods. The PCE is tightly monitored by the Federal Reserve as a measure of inflation. providing a broader and more comprehensive view than the consumer price index by including expenditures not directly paid by consumers, like healthcare costs covered by employers. It helps assess the economic well-being of households and guide the monetary policy. Next, let's look at non-farm payrolls or NFP. Non-farm payrolls or NFP measures the number of jobs added or lost in the US economy, excluding farm workers, government employees, and non-profit workers. It's a crucial indicator of economic health as it reflects the employment trends and wage growth in the private sector. Non-farm payrolls is considered to be the most important economic indicator for the Fed to determine its monetary policy, and so it is a market-moving release. Asset prices typically demonstrate extreme volatility subsequent to the NFP release. Next, let's look at the Purchasing Managers Index or PMI. The Purchasing Managers Index, PMI, is an economic indicator that measures the health of the manufacturing and services sectors based on surveys of purchasing managers. It reflects factors like new orders, inventory levels, production, employment, and supplier deliveries. A PMI above 50 indicates expansion, while below 50 signals contraction. The PMI is closely watched because it provides timely insights into economic activity, helping businesses, investors, and policymakers make informed decisions. It's often used as a leading indicator of economic trends, such as growth and inflation. Market impact is high for PMI too. Last one, let's look at the trade balance. The trade balance, released monthly, reflects the difference between the value of a country's imports and exports. It's a crucial indicator of economic strength as it directly influences a country's GDP. A trade surplus happens when exports exceed imports, while a trade deficit happens when imports exceed exports. The market impact of the trade balance is particularly significant for export-oriented countries like China and Germany. The US-China trade war is a prime example where trade imbalances and tariffs imposed had a profound impact on global markets. With that, let's look at the case study of the US-China trade war. It has a significant impacted the global economic outlook with contentious issues like unfair trading practices, including lopsided tariffs, state-sponsored enterprise, and currency manipulation. Intellectual property theft and forced technology transfer have also fueled tensions between the two economic giants. The China-US trade war has evolved into a broader chip war as well, as both nations compete for dominance in the semiconductor technology, which is critical for modern electronics and national security. The US has imposed strict export controls on Chinese imports of its advanced semiconductors and related technologies, aiming to curb China's access to its cutting-edge technology and limit its ability to produce high-performance chips domestically. More and more tariffs are being introduced to limit Chinese imports into the US. Recently, the Biden administration has introduced massive tariffs on Chinese-made products like the electric vehicles or EV. Even Donald Trump has mooted the ideas of replacing the income tax with more tariffs on Chinese imports into the US if he is re-elected this November. That comes to the end of topic 2.
All right, thank you, Kevin. Now we've covered the various types of financial markets and the factors that influence them. I think it's fascinating to see the connections and the bigger picture they create, right? So I think following our previous structure, it is now time for the topical 2 Q&A. If you have any questions and haven't done so already during the session, kindly scan the QR code on the screen now and make sure to choose the correct topic. Topic 2, factors that move the markets. We'll give you a minute to send in your questions now, and Kevin will start whenever he's ready. Back to you.
Thank you, Zohe. Okay, we have 2 questions here. What is the significance between CPI and PCE? But both usually move quite in line, right? Yes, you are right. CPI and PCE normally moves quite alike, but just that PCE, as mentioned just now, they have some items that are not covered in the CPI, like mentioned just now, the healthcare costs covered by the employers. So just one example. So there are more items that are not covered in the CPI, but in the PCE. That's why in US, right, PCE is the preferred gauge for the Fed to set its monetary policy. Okay, we have another question. Considering that CPI curve is always upward sloping, okay, is a concern, especially since wage growth is much lower than inflation growth. It's a concern that wage growth is much slower than inflation growth. Okay. Is deflation good, and is where initiative to get to deflation? Why target 2% inflation instead? Okay, deflation is good for consumer, obviously, but it's not good from the policy point of view, okay? Because as you know, the government issue bonds to you, right? If there is inflation in the future, government actually pay less for their bonds. If there is a deflation, government needs to fork out more in terms of whatever purchasing power for their bonds when they want to redeem it in the future. So when there is an inflation, actually they just need to pay much less. But of course, like I said, deflation is good for consumer, but it's not good for government. Okay, why target 2% inflation instead? I think 2% is just an ideal inflation where there is no deflation and everybody can accept 2% is just a very mild and benign inflationary target, and that's, I think, universal acceptance to this 2% target. Okay, number 3, how does the Fed determine monetary policy based on NFP? Higher NFP equal to increase in interest rate. Okay, when the Fed sees there's a higher NFP rise, means they are not that keen to decrease the interest rate because everybody is still on full employment, right? So they don't feel the urge to reduce the interest rate. So, but when the NFP is low, more often than not, they will decrease the interest rate because employment is one of the 2 major objectives of Fed. So they will decrease the interest rate if they see the NFP is low. Okay. Okay, let's move on to another question. Does political stability should also be considered as one of the factors? Okay, I think I will cover this in the topic 4, so let's skip it for now. So is there any more question?
All right, thank you, Kevin. I think that concludes the Q&A session for topic 2. And now we will take a brief 5-minute break. Before that, if you haven't done so already, please scan the QR code to complete the registration form and confirm your attendance. Be sure to use the same email and name you provided in the RSVP. Additionally, I'd like to draw your attention to the BPAM Stakeholder Material Topic Survey as part of our corporate sustainability reporting journey. Your feedback is invaluable in helping us identify the areas where BPAM can make the greatest impact. The survey will take around 5 minutes to complete and will significantly guide our ESG and sustainability priorities. So feel free to participate during the break. And an FYI, there will be a recording of the session sent out to all participants after the webinar concludes. That's all, and see you in a bit. So welcome back, everyone. I hope you all had a refreshing break and had time to take part in our survey. Without further ado, it is now time to just dive right back into the next part of our webinar, topic 3, central banks, monetary policy and tools. Do make sure to keep your ears peeled, as there will be a quiz at the end of the topic of the session. And so let's get started to topic 3. Kevin, take it away.
All right, it's time to move on to topic 3 on central banks, monetary policy and tools. Okay, every central bank has its own way of dealing with different types of economic conditions at home. For the US Federal Reserve, it tweaks its monetary policy by adjusting the Fed funds rate, engaging in asset purchases through quantitative easing, QE, and conducting overnight repo operations to manage liquidity. Additionally, it provides forward guidance to influence market expectations about future policy. In Europe, the European Central Bank, or ECB, similarly impacts the economy by setting key interest rates for main refinancing operations, the marginal lending facility, and the deposit facility. The ECB also conducts asset purchase under its Asset Purchase Program, or APP. Meanwhile, the Bank of England sets the bank rate as its primary monetary policy tool and operates an asset purchase facility, which includes purchases of corporate bonds and UK sovereign bonds to support economic stability. Moving on, the Bank of Japan, BOJ, implements monetary policy through yield curve control, targeting both the short-term policy rate and the long-term interest rate, particularly the 10-year Japanese government bond, or JGB yield. In addition to managing interest rates, the BOJ engaged in asset purchases through JGB's exchange-traded funds and Japanese real estate investment trust, JREITs, to stimulate the economy. Up next is the Singaporean Central Bank. Unlike traditional central banks, the Monetary Authority of Singapore, or MAS, utilizes an exchange rate-based policy, managing the Singapore dollar against a basket of currencies rather than focusing on interest rates. We will look into the yield curve control and the exchange rate-based monetary policy tools in details later. As for Malaysia, Bank Negara sets the overnight policy rate, or the OPR, as its primary monetary policy tool, influencing borrowing costs and overall economic activity in the country. Okay, if a central bank wants to stimulate the economy, it adopts an expansionary monetary policy by lowering interest rates. This encourages borrowing, spending, and investment, which can help to increase employment and economic activity. On the contrary, to cool down an overheating economy and control high inflation, the central bank adopts a contractionary monetary policy by raising interest rates. This makes borrowing more expensive, reduces spending and investment, and can help to slow down inflation. Normally, when a country increases interest rates, right, its currency will also strengthen. Vice versa, if a country reduces its interest rates, the currency will also see some sort of depreciation. Last but not least, increasing or decreasing interest rates will directly influence asset valuation and its pricing. Okay, in essence, finance is all about compounding and discounting specific interest rates. In the first example, if you have $1,000 now, and if you want to put it in FD, I mean fixed deposit, of course you look at which bank gives you the higher interest rate, right? Because it will cause your future value to be higher. Future value in this example is the maturity date 1 or 2 years in the future, when you get back your principal plus the interest of your fixed deposit. In the second example, you can think of it as a bond. If you have a series of cash flows promised to be paid in the future dates, if you discount it using a higher rate, you will get a lower present value, or in this case, bond price. Vice versa, if you discount all your future cash flow using lower rate, you will get a higher present value or bond price. Okay, this slide is showing the bond price for a 5-year, 5% annual coupon bond if using a discount rate of 10%. You can see that the bond price is at 81.05, which is lower than the par value of 100. As mentioned in the previous slide, if you discount future cash flows using a higher rate, the present value will be lower. Or you can see it this way. If you have a bond which pays you 5% annually, if your current market yield for your bonds is trading at 10%, of course your 5% coupon paying bond is worth less. Okay, next slide is showing the bond price for a 5-year, 5% annual coupon bond if using a discount rate of 5% as well. You can see the bond price is actually equal to par value of 100 when you do your own calculation. Okay, this slide is showing the bond price for a 5-year, 5% annual coupon bond if using a discount rate of 3%. You can see the bond price is at 109.17, which is much higher than the par value of 100. You can see this way, if you have a bond which pays you 5% annually, if the current market yield for your bond is trading at 3%, of course, your 5% coupon paying bond is worth more, right? Next, tool available to central banks is the quantitative easing or the QE. QE is a monetary policy tool used by central banks to stimulate the economy when the traditional monetary policy becomes ineffective. Under the QE, a central bank purchases long-term securities like sovereign bonds or mortgage-backed securities from the open market to increase the money supply. QE increases the amount of money in the financial system, making it easier for banks to lend to businesses and consumers. The effect of the QE is that the size of the central bank's balance sheet will increase. Next, Asset Purchase Program or APP is often associated with QE as well. It is used by central banks to stimulate the economy, especially during periods of low inflation or economic downturns. While QE is seen as a broader, large-scale policy aimed at stimulating the entire economy, the Asset Purchase Program may be more targeted and can consist of a variety of assets beyond government securities in order to support specific markets or sectors. Just like the QE, utilizing Asset Purchase Program will also increase the size of central bank's balance sheet. Next tool available to central banks is the yield curve control. This tool is used by Bank of Japan to control their long-term interest rate by targeting the 10-year government bond yield. For example, setting it at 0%. It was successfully adopted by Bank of Japan until March this year, when they ended the yield curve control policy due to stubborn inflation and weakening Japanese yen. How it is done is that the central bank actively intervenes in bond markets to ensure you stay within the desired range, which helps to stabilize the economy by managing expectations about future interest rates. Additionally, yield curve control has allowed the Bank of Japan to purchase fewer bonds than it did under the large quantitative easing program that started in 2013. Until late 2016, BOJ was purchasing about 100 trillion yen in JGB each year. As a result, the BOJ's balance sheet expanded at much faster rate than that of other major central banks. Since the initiation of yield curve control in 2016, however, in that three-year setting, up until 2019, the BOJ has purchased bonds at a slower pace, but still kept yields at the 10-year bonds at historically low levels. The BOJ experience demonstrates that credible yield curve control policy can be more sustainable for central banks than a quantity-based asset purchase program. Okay, I have one case study here for the exchange rate-based monetary policy, which is utilized by Singaporean Central Bank, or MAS. The exchange rate has emerged as an effective anti-inflation tool for the Singaporean economy. Over the past 20 years or so, since the exchange rate framework has been in place, domestic inflation has been relatively low. As a result of the long record of low inflation, expectations of price stability in Singapore have become more entrenched over the years. The Singapore dollar is managed against a basket of currencies of major trading partners. Currencies are assigned trade weightage. MAS formulates monetary policy by setting a path for the Singapore dollar nominal effective exchange rate, or the S dollar and EER policy band, to ensure price stability in the medium term. It's a managed float regime, and it is allowed to fluctuate within a desired policy band. Policy band is reviewed periodically to ensure it remains consistent with underlying economic conditions. Changes can be made to the following parameters. Number one, the slope of the policy band, i.e. its rate of appreciation. Number two, the width of the policy band. And number three, the level at which the policy band is centered. Okay. The diagrams at the bottom of this slide are the parameters mentioned earlier. Just a quick note, MAS doesn't disclose the exact parameters in their monetary policy. However, when MAS changes the monetary policy stance, it provides the quantitative descriptions of the adjustment to the policy parameters. For example, something like a slight increase in the slope, but you don't know the exact the rate. Okay. Additionally, MAS doesn't disclose the currencies in the Singapore dollar nominal effective exchange rate basket or their trade weightage. So, does MAS engage in currency manipulation? Well, back in 2019, MAS said Singapore does not engage in the currency manipulation after US added the country to a watch list in a semi-annual report by the US Treasury Department. The US Treasury cited Singapore's large current account surplus and foreign exchange intervention operations. In defending the exchange rate monetary policy, MAS pointed out that Singapore does not manipulate its currency for export advantage. On the contrary, its monetary policy framework, which is centered on the exchange rate, is to ensure medium-term price stability and will continue to do so. Case in point, these few years, we have seen a surge in consumer prices around the world. As a major importer of consumer goods, Singapore has no other choice but to let its Singapore dollar to appreciate against other currencies so that the imported inflation is kept at bay. This is why the Singapore dollar strengthened a lot against Malaysian ringgit in recent years, right? You don't listen to those street politicians or economists on why Singapore dollar is so strong against the Malaysian ringgit. They normally don't get to the point. Previously, I mentioned that both the QE and APP will expand the central bank's balance sheet. QE or APP means the creation of central bank's money to purchase assets like sovereign bonds, ETFs, and REITs, etc., as mentioned earlier. To put it simply, okay, a typical central bank's balance sheet has two parts. The one on the left is the asset it purchased. The one on the right is the liabilities, normally made up of currency in circulation and the reserves of the commercial banks. Unlike the traditional balance sheet of a company, a central bank can create money, or in layman's term, print money out of thin air by increasing the currency in circulation. To balance it out, the increased currency supply has to go buying assets like government bonds, ETFs, REITs, or even stock, and sometimes gold. Then both sides get equalized. As a result, central banks who adopted QE have seen the size of their balance sheet increase. For example, the Fed has introduced multiple QEs during the global financial crisis and the COVID pandemic. It has expanded to $9 trillion at one time before the Fed shrank the balance sheet to around $7 trillion to contain the inflation recently. Let's look at the effects of monetary policy on assets pricing. A dovish monetary policy through either interest rate cut, balance sheet expansion through asset purchases program, or QE, we'll see stock prices rise, bond yields drop, gold prices increase, and currency weakens. While a hawkish monetary policy through either interest rate hike, balance sheet unwinding, QE tapering, we'll see stock price drop, bond yields rise, gold price decrease, and currency strengthens. Okay, that comes to the end of topic 3.
Thanks a lot, Kevin, for shedding light on topic 3. I think we all know the drill now, so let's dive straight into the topical Q&A session. If you've got any burning questions and haven't done so already, scan the QR code on the screen now and make sure to select the correct topic, topic 3, so we can get them answered. Just a reminder that any unanswered questions will be answered via email after the webinar concludes. Back to you, Kevin.
Thank you, Zohe. Okay, let's get straight to the question. Appreciate if you could share your view on whether the Malaysian ringgit will continue to appreciate significantly after the Fed decision on interest rate in September. Yeah, I believe the ringgit, especially against the US dollar, will keep on strengthening if the Fed decides to cut 50 bips. At this moment, I think the market consensus is 50 bips. I mean, anything less than 50 bips, perhaps we'll see ringgit weaken back to perhaps 4.4 or 4.5. I mean, that's my view. And anyway, okay, if there cuts 50 basis point, perhaps ringgit can see 4.3 or below, 4.2 perhaps. I mean, let's hope. Okay, second questions. When calculating the price of a bond, how do we decide the discount rate, 5% or 10%? Okay, what rate do we use for discounting and why? Okay, this is directly the bond pricing question. Okay, we use the current market yield for the equivalent bonds, typically observed through recent market transactions for bonds of similar credit and tenure. Okay. In the Malaysian market, such rate can be obtained from BPAM, obviously from us. Meanwhile, for international bonds, such yield can be obtained from data providers such as Bloomberg. Okay, so it's actually just based on market trade, okay, whether you want to discount it using 10% or 3% or even at 5%. I mean, the example I gave just now, okay. So if the market is very bullish, probably you need to discount it using a lower yield because currently market is trading at a lower yield. I mean, the market is bullish means the yield is lower, okay. If the market is bearish, I mean, for bond market, bearish means the yield is currently trading at a much higher rate. So probably at the time you have to discount it using a higher rate. Okay, so it all depends on market, the current interest rate environment. Okay, I hope that answers your question. Okay, we have question number 3. Why does Malaysia not follow Singapore's exchange monetary policy? Okay, what happened to Malaysia if we do? Okay, I think that Singapore example is a very unique case because Singapore is a very small economy, and unlike we Malaysia, we have a very diverse economy. For Singapore, they are just an import-export country based on trading. I mean, based on trade. Okay, so for them, interest rate doesn't play a part to control their inflation. So they prefer to use their exchange rate policy to control the inflation. Okay, so Singapore is a different animal, I would say, in this entire scheme of thing. Okay, because I believe only Singapore is using exchange rate monetary policy. Okay, you see all the major central banks around the world, right? They all still use interest rates to control their inflation and even how to spur their economic growth. Okay, so only Singapore is using interest rate to control the inflation and to spur their economic growth. Okay. I think that's all for the Q&A questions for topic 3.
Thank you, Kevin, for answering topic 3 Q&As. Now it's time for the 4th and final topic, geopolitical developments and the impact on the financial markets. Over to you, Kevin.
All right, let's move on to our last topic for today, which is the geopolitical developments and their impact on the market. First, let me quickly go through some political terms with you all. I believe you all have come across this in mainstream news. Right-wing ideology are often associated with market economy, capitalism, fascism, nationalism, small government, and lower tax. And the left-wing ideology often associated with planned economy, socialism, communism, welfare state, and big government and higher tax. Of course, political spectrum can span from ultra-left to ultra-right. Anything in between is called centrist. Generally speaking, Republican Party in the US and the Conservative Party in the UK are right-leaning, while the Democratic Party in the US and the Labour Party in the UK are left-leaning. Market impact is extremely high after election. Okay, here are the characteristics of right-wing politics. Okay, number 1, lowering tax to spur economic growth so individuals can have more disposable income and businesses can hire more people. Number 2, advocate for small government, only concentrate on essential like public spending, like the education, internal security like police and immigration, and border security like military. Number 3, advocate for market economy. They believe the invisible hand will self-regulate the economy without government intervention. And finally, the approach they take is to be fair to everyone at the start, meaning equal opportunity. Okay, how about the characteristic of left-wing politics? Number one, tax the rich to give it to the poor so that the income inequality will narrow. Robin Hood comes to mind. You know, Democrats presidential nominee Kamala Harris has recently proposed to increase the corporate tax rate to 28%, reversing Donald Trump's signature legislation in 2017 that slashed the corporate tax rate from 35% to just 21%. Number two, advocate for big government, increases the public spending in every aspect, from education to healthcare, and subsidize the poor. Concept of welfare state comes to mind. Number three, advocate for centrally planned economy. They believe government should control and regulate every aspect of the economy. You know, something like the communist government likes to do, i.e. North Korea. By the way, China has long abandoned this centrally planned economy since they adopted the quote-unquote reform and open up policy under Deng Xiaoping. So China is by name only communist, but their economic model is already moved on from centrally planned model. Number four, the approach they take is to be fair to everyone at the end, meaning equal outcome. Actually, there's a saying that goes, if you are not liberal when you are young, you have no heart. If you are not conservative when you get older, you have no brain. This quote suggests that younger people tend to be more idealistic and support progressive or left-leaning policies, while older people become more pragmatic and shift towards conservative or right-leaning views. The idea is that with age, people might prioritize stability, security, and traditional values more. For me, this is just a natural progression. When you are younger, you had nothing to lose and tend to be rebel without a cause, supporting liberal and progressive values. But when you get older, you have had enough of this already, and perhaps already accumulated some wealth too. So of course, by that time, you don't want to be taxed more and more by your government. Let's look at the case study, the impact of UK election in 2019. When Boris Johnson led the Conservative Party to victory in 2019, UK stock market rallied and the pound sterling surged against the US dollar. The Conservative or Tories victory means the removal of lingering concerns of Jeremy Corbyn's Labour Party nationalising major industries and utilities, as well as hiking tax rates. Just before the election, Labour Party had launched its General Election Manifesto, promising to quote-unquote transform the UK and to renationalise rail, mail, water, and energy. The party said this would be paid for by tax increases on higher earners and reversing corporate tax cuts. Market viewed the election result positively as huge mandates secured by the Tories removed doubts of hung parliament and a Brexit deadlock. Next on our discussion today is the New World Order. The term New World Order reflects the shifting dynamics in global power, with traditional Western dominance being increasingly challenged by emerging powers like China and Russia. The world is transitioning towards a multipolar order, where multiple nations hold significant influence rather than a single superpower. This shift has increased geopolitical tensions, particularly between US and China, or to some extent Russia, prompting realignments in global alliances and economic partnership. Malaysia has recently applied for BRICS membership is one such example. Also, technological dominance, especially in advanced technologies and digital infrastructure, is now a crucial factor in maintaining global influence. Meanwhile, international institutions international institutions face more and more difficulties adapting to these changes, raising questions about their future effectiveness. Case in point, the UN Security Council. It seemed to us that the UN Security Council can't do anything with the wars that are happening around the world at this moment. Here are the list of some of the global hotspots. Number one, Middle East, especially between Israel and Hamas, Hezbollah, Houthis, and Iran. Then we have North Korea for its ballistic missile and rocket tests that endanger the airspace of the neighboring Japan. Number three, not to forget the Chinese military expansion in the South China Sea, as well as its ambition to conquer Taiwan one day. Of course, the Ukraine-Russia war that has already entered into the third year, as well as into a new phase, in which currently the Ukrainian army seems to make some progress into the Russian territory. Okay, whenever there are military conflict, we will see an increased demand for safe haven assets like the US dollar, Japanese yen, gold, and US treasuries. Okay, why the Japanese yen is considered a safe haven asset? It's a safe haven asset despite Japan being one of the most indebted nations in the world, which seems counterintuitive. The view stems from the Japan's trade surplus, where the country exports significantly more than it imports, leading to decades of current account surplus. Additionally, Japan holds a substantial amount of net foreign assets, meaning the value of foreign assets held by Japanese investors far exceeds the value of Japanese assets owned by foreigners. During times of economic uncertainties, these investors tend to repatriate their foreign capital into yen, driving demand for the currency and reinforcing its status as safe haven. Okay, moving on, what is a black swan? A black swan event refers to an extremely rare and unpredictable event with severe consequences. A concept coined by Nassim Nicholas Taleb in his 2007 book called The Black Swan. What else, right? Despite being unforeseen, many argue that such events should appear predictable in hindsight. Investors are advised to always consider the possibility of a black swan event, however unlikely, and plan accordingly. One approach is to make long-short bets, such as using out-of-the-money options, which involve a low capital outlay but offer huge potential pays out if the black swan prediction comes true. Here are some of the historical black swan events from 1997 Asian financial crisis until the most recent COVID pandemic. Some argue that the COVID pandemic is not a black swan event, as public healthcare emergency should be predictable. But bear in mind, although the pandemic itself is not a black swan, but the aftermath and the fallouts from the pandemic are definitely black swan. Nobody in his serious mind would have predicted the damage it caused the economy. Okay, let's move on to gray rhino. A gray rhino event is a metaphor used to describe a highly probable, high-impact event that is often ignored or underestimated until it's too late. The term was coined by Michelle Walker in her book, The Gray Rhino, published in 2016. The metaphor highlights the idea that these events are like a charging rhino, dangerous and impossible to miss, yet often ignored. Because you look at a rhino, they don't seem like can run, right? Common examples are climate change, financial crisis, public health threats like pandemics. These situations where the risks are known and visible, but action is delayed or insufficient. The concept encourages organizations, governments, individuals to recognize and address these threats proactively, rather than waiting for them to escalate into a full-blown disasters. Okay, before we conclude today's presentation, just a quick look for the rest of 2024. The global economy and the geopolitical landscape remains tense, with inflation expected to stay high for some time, but it's showing some signs of easing, despite hawkish stance from central banks. However, the Fed is now expected to adopt a more dovish approach. Meanwhile, the US and China are increasingly at odds on multiple fronts, raising concerns about future conflicts. As for the upcoming US presidential election in November, its result could have major implications for various asset classes. The Ukraine-Russia war may see an earlier resolution if Trump is re-elected, while the Israel-Hamas conflict outcome largely depends on the Israel willingness to pursue peace. That's the end of topic 4.
Thank you, Kevin, for your insight on such timely and important topics, especially in the light of the ongoing events in the Middle East and Ukraine. So now let's move on to our topical Q&A session. If you have any pressing questions, please scan the QR code displayed on the screen now and select topic 4, geopolitical developments and the impact on financial markets. To remind you again, any unanswered questions will be answered via email after the webinar concludes. As a reminder, any questions that remain unanswered will be given via email in the conclusion of the webinar. And over to you, Kevin.
Thank you, Zohe. Okay, we are still waiting for questions to come in. So let's wait for a while. Okay, perhaps I can answer some questions on previous topics. Okay, for example, just now there's a questions on what is the difference between private placement and book buildings. Okay, like I mentioned just now, book buildings, you can have access to wider audience, while private placement, you can only address a limited pool of investors. So in terms of this reach, book buildings definitely have a wider reach compared to private placement. Okay, let's see whether we have questions for topic 4 or not. Okay, how might Malaysia's financial markets and investment climate be affected by closer ties with BRICS nation? Okay, I think as we all know, Malaysia, the international stance is be neutral to all parties. Okay, we don't side with US, we don't side with China or any other countries. Okay, we are just doing what we want. We are being neutral. So by Malaysia joining BRICS, of course, we can have access to more wider market. I mean, for our products to reach them, and of course, it's good for trading. Okay, and I also believe recently there are talks about whether we should replace US dollar as the medium of exchange for international trade within the BRICS nation. Okay, so I believe once we join once we successfully join the BRICS, we probably could use other currency for our trade within the BRICS community. Okay, I hope that answers the question. Okay, next question. How does current geopolitical tensions affect Malaysian market and ringgit. Okay, at this moment, I think Malaysian ringgit is kind of like immune to all these events. Of course, ringgit is not immune because of US dollar value, but if against other currency, right, like Chinese yuan or even like Japanese yen, I don't think ringgit value has moved because of all these events. Okay, geopolitical event most likely will affect the value of US dollar. Okay, and of course US dollar will affect ringgit, but ringgit by itself won't be affected by all these geopolitical tensions. Okay. Do we have more questions?
All right, thank you, Kevin, for addressing those questions. We will now move on to the end of session quiz. So please scan the new QR code displayed on the screen now to access the quiz. The quiz consists of 3 multiple choice questions designed to test your understanding of today's 4 topics. You will be given 1 to 2 minutes to complete the quiz, after which Kevin will review each question. Kevin, the floor is yours whenever you're ready.
Thank you. Okay, let's wait for 1 or 2 minutes before I disclose the answers. Okay, I think that's about the time. 1 minute is up. Let me get to the questions and answer. Okay, question 1. In the futures market, will the margin requirement increase accordingly when the market is getting more volatile? Okay, I think the answer for this is yes, obviously. Okay, when the market is getting more volatile, your broker may require you to put up more margin, also known as money, into your brokerage account so that they can protect themselves. Okay, because if you don't pay it up, they have to bear the losses. Okay. Number 2, Federal Reserve prefers to use which tools as its input to measure inflation? I think the answer for this is straightforward. The answer is PCE. Okay. If you follow the materials presented just now, you should know the answer is PCE because PCE has items that are not included in the CPI, like the healthcare costs covered by your employers. Okay. Question 3. Which of the following is not a safe haven financial asset? Okay, I think this one also quite easy, right? The answer for this is Bitcoin. Cryptocurrency like Bitcoin is highly volatile, and the maximum drawdown from the peak can be as high as 90%. Okay, I mean, especially if you look at the price of Bitcoin historically, it did lose 90%. Okay, because of this, Bitcoin is not a safe haven asset. Okay, that's the end of today's workshop. Thank you for tuning in.
Thank you for everyone's active participation and insightful questions. We sincerely hope today's session has provided you with valuable insights and new learnings. So a special thanks to our speaker, Inchit Mio, and our trainer for the day, Inchit Kevin, and for all of you guys who have made today's workshop possible. Again, it's worth noting how grateful we are at BPAM to be hosting you today, and we hope to be doing this again with you all really soon. So please stay tuned for any future webinar sessions by following us on Twitter, X, LinkedIn, and Instagram to get the latest news on this. It is also a great place to keep up with BPAM in general and the global economic updates. Again, I'd like to draw your attention to the BPAM Stakeholder Material Topic Survey. The survey will take around 5 minutes to complete and will significantly guide our ESG and sustainability priorities. If you haven't done so already, please make sure to register your attendance in order to receive your personalized workshop certificate, and additionally to participate in the survey. On behalf of everyone at BPAM, thank you, and we hope to see you all real soon. Bye-bye.